Hi, this is Roger Conrad. I'm editor of Canadian Edge newsletter, and I've got a couple things I want to talk to you about today regarding Canada. This newsletter covers a full range of stocks and Canadian trusts located in Canada. It's a pretty exciting country. It's very much a resource-oriented country with a lot of oil and gas. Of course, they export a lot of it here. More and more, they're exporting their resource bounty to China, and that's been a very good thing for this country, for that country. Over the last year or so, as the demand for some of these materials has dropped off in the U.S., it's picked up in China. And of course, all eyes have been on China with the Olympics, and you can sort of get a little glimpse there, looking at some of the huge construction that's been going on, the massive infrastructure building, and so forth. These are very long-term trends. There are a lot of people moving from the rural areas of China. It's traditionally a rural farming country. Into the fast-growing urban areas, and that means you have to build roads, you got to build buildings, you got to have power infrastructure, a whole range of things that require raw materials. And of course, Canada has emerged as very much a treasure house for the countries of Asia, and particularly in China. So, because of this Chinese demand, they've been able so far to buck the downturn here in the United States. In fact, if you look at some of the indicators there, particularly bank credit conditions, considerably better than in this country. Part of that's because they avoided a lot of the excesses that U.S. banks, the U.S. financial system went in for, particularly in the mortgage area. In fact, the only really weakness that you see in that sector in Canada right now is pretty much connected to what they do in the United States, how many mortgage securities they bought, and of course the exposure is all around the world. But basic business conditions appear to be in better shape, particularly regarding access to credit and the health of the banks there. So that's a tremendous plus. And to a large extent, it's an offshoot of that reliance on resources, which has really kept things going in that country. Now, right now, a lot of the chatter is about will the slowdown in the U.S. begin to have more of an impact there? And we're seeing some of the fallout on Canadian securities. In fact, you're seeing, I think, a good pricing in on the Toronto Stock Exchange, be you talking about corporations or Canadian trusts, pricing in really some of that already. A lot of the trusts and energy producers, for example, have come well off, and certainly more than would be justified if you just looked at the drop in oil prices from the peak, or the drop in natural gas prices from the peak earlier this year. But the market's pricing that in, and that usually means one of two things for investors. First of all, if there is a big problem developing, if the U.S. contagion does spread into Canada and begin to slow things down there in a more meaningful way than people have expected to date, a lot of that's priced in already, so the downside risk of that's not incredibly low. Second, if it doesn't happen, and it really hasn't happened yet, you're still seeing very strong indicators from real estate, and particularly in the energy patch there, and even in the industrial sector, not weakness to the extent you've seen here. So if those conditions hold up, then I think you're going to see some strong appreciation, and even more important, longer term, looking forward, this new connection with China and basic tremendous call on natural resources for development and throughout the world. That's a tremendous plus for this country and economy going forward. So I think there's some tremendous opportunities up there. We are still seeing the Canadian trusts in particular linger or languish under the specter of 2001 taxation. A lot of people are afraid to invest there because there will be conversions very likely from trusts to corporations that would more than likely mean reduced distributions in many cases. There are some, and so that's basically priced in as well, even though we've seen some conversions take place already that have actually resulted in some fairly strong shareholder returns since those changes were made. I think the most interesting area right now to focus on in the trust area, and we're focusing on it, in fact, in the August issue, would be the energy services area. And this is a sector that was red hot up through the middle of 2006, not surprisingly, because natural gas prices were rising, oil prices rising, and drilling activity, which really drives these things, was on the rise. So whatever they had, services or rigs in particular, were in very high demand. Rates were going up. margins were going up, revenues were going up, they were expanding at rapid rates, growing their distributions, and generally doing very, very well in the share market, one of the hottest performing sectors. That changed with a vengeance, ironically, beginning in 2006 as gas prices peaked in the wake of Hurricane Katrina and the spikes there. People started conserving a little more, we got milder weather, and so we had a tremendous drop-off in natural gas prices that took place really beginning in early 2006 and lasting through really the beginning part of this year. And the result was, margins peaked for these companies, and then things started really dropping off a cliff beginning in the latter part of 2006. And with the trust taxation announcement restricting the number of shares they could issue, and also bringing prices down in a really big way, they really were cut off from new capital. So you had a wholesale meltdown in this sector. Reversed a little bit at the beginning of this year. You started to see conditions somewhat bottoming for the industry in terms of drilling, new areas opening up, even some of these traditional areas where the activity had really dropped off a cliff, starting to stabilize a little bit. Of course, an opportunity in the oil sands starting to emerge there, and with oil and gas prices picking up, more enthusiasm. So you had a nice big move up in these things that reversed to a large extent in July. So I think we have another opportunity to take a look at some of these things. The biggest one out there right now in Canada is precision drilling, and it's gone this year from a price in the low to mid-teens, got all the way up to around $30, and then has since backed off to the low 20s. So I think it's that's an interesting one. Another one that's already converted to a corporation, Trinidad Drilling, has not had quite those massive fluctuations, still pretty close to its high. It's different from the other trusts, the other service trusts, in that it focuses on deep drilling rigs in the United States primarily, and signs these companies, its clients, onto long-term contracts. So it's made its revenue steadier, it's made its cash flow steadier, and it's been able to continue to expand even while some of the smaller trusts and even Precision have had to really kind of pull back a little bit in the wake of this real major two-year depression. But I think those types of things. I think there's some smaller ones too. I think energy prices, if they should soften a little bit here, we could see a little bit more weakness. But again, a lot of that's priced in already, as is that entire market. And as things do start cycling out, I think we will see some tremendous gains in that sector going forward. So this sector, I think, is very exciting right now. I think we're going to see some considerable appreciation. I think the long-term bull market in energy is very much intact. We could see some pullback for prices continuing, perhaps taking oil down to $100, perhaps lower, perhaps natural gas back into the $7 to $8 per million BTU range. But certainly these companies are already pricing that in. And history shows that when you have a drop in demand due solely to economic considerations, in other words, people pulling back in the midst of a recession, it's fundamentally different than permanent demand destruction via conservation or switching to alternatives. And in fact, when you do have a recession-related drop in demand for energy, it tends to be swiftly reversed when you have the inevitable upturn. So again, until we see a lot more conservation, until we see a lot more use of alternatives, we're going to see we're going to see very strong energy prices, and I think we're going to see a lot more drilling activity. So again, I think we're probably at the beginning of a nice new wave for these things, and it's a good time to buy in. Thanks very much for tuning in. I look forward to chatting with you next time.